welcome to the deep dive. Today we're cutting straight to something really crucial in trading.
Yeah, we're looking at time frames.
Exactly. How the time frame you choose to view the market, well, it totally changes the trading signals you end up seeing.
Mm-hmm.
Our source today is a trading tip focused right on this, and our mission really is to understand how that choice impacts your trading, especially, if you're aiming for those quick, short-term trades.
And what jumps out immediately right off the bat is this kind of fundamental trade-off the source points out.
Which is?
Well, the faster you look, the shorter the time frame, the more potential buy or sell signals pop up.
Okay.
But as you might guess, more doesn't always mean better. Quantity isn't necessarily quality here.
Right, exactly. And the tip gets specific about short time frames. We're talking like 1 to 5 minute charts.
Uh-huh. Really rapid views.
And the key thing it says is that these fast views, they generate a lot of signals. It's like watching every tiny ripple on a pond, you know?
That's a good way to put it. And just like those little ripples don't always tell you about the main current.
Right.
A lot of these quick signals can be, well, misleading. The source is pretty direct. It warns about a lot of false signals on these short charts.
Full signals, okay.
Think of it like trying to predict the ocean's tide just by watching the individual waves hitting the beach.
Ah, okay. Lots of action, but not the big picture.
Exactly. Lots of movement, but maybe not showing the real underlying trend. Those short time frames capture every little price wave, and many of those just aren't part of the bigger market tide.
That makes perfect sense. So if you were playing in that fast-paced sandbox, what's the suggested way to handle it?
Well, the source uses this memorable phrase. It says, it's good for hit and run quickly.
Hit and run quickly. So
Yeah.
get in, grab a small profit maybe, and get out fast.
Precisely. The strategy has to match that speed. You're not really aiming for those big long-term wins.
Right.
It's more about capturing these little fleeting opportunities. And the source even puts numbers on small.
Oh, yeah. What does it say?
It suggests aiming for a profit target of just a 0.25% to 0.5% for each of these quick trades.
Wow. Okay. Those are really tight margins.
They are.
Which I guess really highlights the need for discipline, right?
Absolutely. And speaking of discipline, the source gives a very, very strict rule for managing your risk.
What's the rule?
It says strict stop loss should be the low of previous candle.
Okay. Low of the previous candle. And just quickly for anyone listening, a candle is basically that visual bar on a chart showing price movement over that time frame, like 1 minute or 5 minutes.
Right. So setting your stop loss there at the bottom of the price range from the last period is meant to cap your potential loss if the trade immediately goes against you.
It sounds like a critical safety net, especially with all those potential false signals floating around.
It really is. You absolutely need something to stop a small loss turning into a big one. And the source is very firm on this.
How firm?
It states, quote, target and stop loss rules are not to be violated in any case.
Wow. No wiggle room.
None. That kind of strict adherence seems vital if you're playing that high-frequency, short-term game.
Okay, so that paints a clear picture of the short-term world.
Yeah.
Fast, potentially lots of signals, maybe lots of false ones, needing super strict rules.
Exactly.
So let's flip the coin. What about the other end? Longer time frames?
Right. The source contrasts this directly. It says, larger the time frame you use, fewer will be the trading signals.
Fewer signals. So the market whispers less often, you could say.
It seems so, but, and this is the crucial counterpoint,
Uh-huh.
those fewer signals are described as, but more reliable ones.
More reliable. Okay, so quality over quantity now.
That seems to be the idea. It suggests that by looking at the market over, say, hours or days instead of minutes, you filter out a lot of that short-term noise.
Right, the random fluctuations.
Yeah. And you might identify signals that have a, well, higher probability of actually playing out as a successful trade. So you shift from many potential trades you're less sure about to fewer trades you might have more confidence in.
So for you listening in, the big takeaway here really seems to boil down to this.
Yeah.
The time frame you pick isn't just a setting.
Not at all.
It fundamentally shapes what you see, how many potential trades pop up, and crucially, how trustworthy those signals might actually be.
Mm-hmm.
Shorter time frames,
Mm-hmm.
more action, maybe quick small wins, but you have to manage that risk tightly because of those false signals.
Right. Higher frequency, potentially higher noise.
In longer time frames, it's a less frantic pace, fewer signals, but the ones you get could potentially be more solid.
Exactly. And understanding that trade-off, that relationship, it lets you make a more informed choice, doesn't it?
Yeah, definitely less overwhelming.
You can pick a time frame that actually fits your own trading style, how much risk you're comfortable with, what your goals are,
Yeah.
rather than just getting, swept away by every little up and down tick.
Yeah, that makes a lot of sense. Considering all this, it really leaves you with a final thought to chew on, doesn't it?
Like what?
Well, what's the sweet spot? How do you, the listener, balance that desire maybe to be actively involved, to catch opportunities, with the need to have real confidence in your decisions without just getting bogged down by all the market noise?
Hmm. That's a really interesting question. Finding your optimal balance between frequency and reliability. Definitely something to think about.